Good afternoon and welcome. It's an important day for all of us with our Finance Minister Nirmala Sitharaman presenting the Union Budget 2024. And as promised, we are here to decode it for you. I'm Lisa Pallavi Barbora, and with me is Monika Halan, who is a well-known financial educator and author. And what we are going to do is just simplify some of what she said in the speech, and we've gone through some of the documents as well to bring just the simple details on what it means for you. So some of the details may come out later as well, but right now here is the first impression. Hi, Monika.
Yeah, hi. Like budget days are always a little crazy.
Yeah.
But I think before I get into what it means for all of us, I think I need to set the context of the backdrop of this budget. So the backdrop really is that India is in a very good space in the macro. We've got tax revenues are up, the RBI's dividend is there. So for the first time in many years, there is money in the pocket of the government to do a little bit of spending while remaining very conservative on the borrowing part. Okay, so, and also there are two problems in front of the country today. So earlier it might have been that the deficit was too large, but right now the problem is that we are not seeing consumption,
right?
Bloom in the country. Consumption happens because of either people consume within the country or you export, right, and or both.
Yeah.
Both have been very tepid in terms of exports as well as consumption. And that is linked to jobs, which a lot of people say it's been a jobless growth that we have seen in the past years. And that is linked to private sector investments, which have been tepid. Right, so these were the problems in front of this budget. And to a large extent, I think the finance minister has tried to address this with a whole slew of different proposals for triggering consumption and trying to get jobs kick-started. So let me just first start off with what it means for an average person.
Sure.
Now, we know that there are two tax regimes.
Yeah.
There is an old tax regime which has all the deductions and exemptions and rebates are there for both, but basically deductions. I think there's a list of some 30, 40 deductions which are out there which a person can
Section
take.
80C, the key.
80C is just one. There are other deductions. So it's a whole maze of things that you can do to lower your tax burden. So a few years back, the government gave an option to people to say that don't take any deductions, right, but we'll give you a lower tax rate.
Yeah.
So they called it the new tax regime. And the finance minister today said that 2/3 of the people have actually moved.
That's right.
I don't know about you, but I know that I have moved to the new one simply because you see a difference in the tax that you pay. Yeah. So what they are trying to do is they're trying to nudge people more and more towards that. So all the benefits which are coming to a regime which has they have only two deductions. The standard deduction is there, and I think the NPS deduction is there for the new tax regime. So in that, we've seen a reduction of the tax rates. So the slab levels have gone slightly up. Yeah. So below 3 lakh, you pay no tax. Yeah. 3 to 7 lakh, you're paying 5%. 7 to 10, you're paying 10%. 10 to 12 lakh, you're paying 15%. 12 to 15, 20%, and more than 15, 30%. And these two last were what they were earlier. So the benefit of a higher threshold has been given to the population who was earning at the lower ends of the scale. Right. So again, in the context of India, we have to see that there are few people who are well off, and there's a very large population which is not doing well, which does not do well, who are poor, who are still on food support. So the idea has been to benefit the lower income group who's been hurting because of higher taxes, and inflation has been high. So I think back of the envelope calculations, 17,500.
That's what she said.
She said that is the benefit that a person would get.
Because she's also increased the standard deduction.
So I was just coming to that. So if you include this, so this is one part that you have raised the slab so that the incidence of tax is a little lower on you. there is no benefit on the people on the old tax regime.
Right.
The other thing she's done is the surcharge is still there. Okay, so
for higher income.
For higher income groups. So for people, I'm sure everybody knows that if you earn more than 50 lakh, there is a surcharge. There is also a cess.
Right.
So those cesses and the
tax.
surcharges remain.
Yeah.
There's no escaping that.
Yeah.
So India's marginal tax rate remains at a 39% at the top. I think incomes more than 5 crore.
Yeah.
You are still paying, like, you know, if you are lucky enough to have an income, annual income of more than 5 crore, you are losing 39% at the margin to the government. The other thing that she's done is she's raised the standard deduction from 50,000 to 75,000. This is essentially, it is aimed to equalize a salaried person's expenses which they cannot claim, vis-a-vis say a consultant who's able to claim transport and entertainment and subscriptions. They are able to claim that as an expense. So the salary people say, but we are also make those expenditures. We are unable to claim them. So this is that amount which goes towards, say, your Wi-Fi bill or your travel cost or any costs associated with earning that income. So that has got increased from 50,000 to 75,000 for only the people on the new tax regime. So the overall benefit, like you said, is 17,500.
That's what she has calculated.
She has calculated. Too early for us to do the Excel sheets
it's
today.
Up to that much.
Up to that much. So depending on where you stand at the highest, this is what people are gaining. So that is essentially the gain to the salaried class. It's not much. I don't think it has the potential to boost consumption in a major way.
That's the requirement, right? Like you were saying.
So the requirement was to boost consumption. There were certain ideas earlier that extend some of the deductions to, say, expenditures on TVs, fridge. I think it came too late in the day for them to incorporate that. But possibly that is a road ahead, that if you really want to boost consumption, you may need to extend the tax benefits on actual spending by people. So pretty much this is what you gain, and there are losses ahead.
I mean, that kind of change does require a lot of creativity. So maybe, you know, let's see how it goes.
And the next budget is not that far away. We are just, this is full budget. We've done the interim.
8 months.
This is the full budget for the rest of the year.
Another important thing that she did announce with respect to taxes is in the capital gains front, right? We were expecting something to happen, and I think there were diverse views. Obviously, people in the capital markets would have liked something that's favorable, but that's not what happened.
Right, that's not what happened. So let me first explain what this is. So what is an asset? An asset is something which throws off income and profits. Both incomes and profits are taxed by the government. Incomes typically are taxed at your slab rate. Profits are divided into two. There's short term, depending on how long you hold an asset. There's long term. So typically, between 1 to 2 years, it goes long term, depending on what kind of asset there is. The entire capital gains system is a mess because different assets are interpreted in different ways for calling them short-term or long-term capital gains, and they're taxed differently. Different presentations of the same asset, if it's physically held or held through a financial instrument, are taxed differently. So it's a mess. The government has already announced that they will clean it up. And I see a lot of these proposals which tell us that we are on the path. So according to me, what is a good way of doing it is that you remove the tax-induced choice of me as an investor to pick a certain asset. Equalize short-term and long-term tenors. They should all go short-term or long-term at the same time. Standardize it.
I shouldn't have to make an investment choice based on the tax.
And equalize the tax rates. So I'm seeing some things here which have not been very good for equity. Essentially, so they've done two things. Short-term rates, which means when you hold the asset for a lesser number of years, has gone from 15% to 20%. So they've raised that.
Right.
And they've raised the long-term rates from 10 to 12.5% for equity, but for certain other asset classes, this has actually gone down. Let me just decode this.
Yeah, because it wasn't standard till now, and the attempt is to standardize it.
So let's just take equity first, because markets are the most visible.
Yes, and markets did crack.
They did crack because what has happened is so equity goes long term at 1 year, which remains.
Right.
Even today, equity will go long term if you hold for 365 days.
Right.
366th day, your asset has gone long term, and the tax rates are different. So if you book a short term profit, then instead of 15%, now you'll pay 20%. So it's a dampener. And the long term rate after 1 year used to be 10, now it's 12.5. But what they've done is they've given a little bit of a break to people who make small amounts of profits. Earlier, profits up to 1 lakh were exempt from this tax. Now 1.25 lakh is exempt. So there is a little bit of a carve out for people.
I think up to about 250,000 kind of capital gain.
That's right.
It's neutral.
About that much, 2.5, That's right. So that's for equity. So equity markets did not like this at all.
Yeah.
But there are other asset classes which are hurting. So let's come to real estate. For real estate, it goes long term at 2 years.
Right.
The short term capital gains is now at 20%.
Right.
And the long term is now down to 12.5%. It used to be 20%. But at 20%, they would get something called indexation. Right? Now, just to explain what indexation is that when you buy an asset at 100 rupees and you sell at 200 rupees 10 years later, the value of that 200 is very different. So you are
thanks to inflation.
So indexation allows you to raise this 100 rupees to take care of the inflation which has happened. So essentially your buying price gets raised, so the profit that you have shown gets reduced, so the tax is less. That's called the indexation benefit.
Right.
Equity earlier at 10% long-term capital gains tax did not have this indexation benefit. It seems that both gold and real estate have lost it.
Right.
Okay, they've lost this indexation benefit, which actually really used to reduce the amount of tax that you needed to pay. So real estate now is seeing a reduced tax rate, but has lost the indexation benefit.
You know, one thing just struck me as we were talking. For equity investors, actually, the short term was 15% earlier, long term was 10%. So difference was 5%. Now, actually, the difference has increased. Right?
That's
to
right.
7.5. So the incentive to be a long-term investor is perhaps, slightly more. So maybe that's not such a bad thing, actually.
Yeah, and also I think if they have announced that they will clean this up, so somewhere maybe the nature of the product should also kick in. Real estate is a long-term asset.
Absolutely.
Why are you fueling speculation by making it go long-term at 2 years? Long-term in real estate, I think, should at least be 10 years. And equity also actually is a long-term asset.
Absolutely.
So why is it 1 year? I'm not trying to crash markets here, but some thought has to go in as to the purpose of that asset class in the hands. But I want to come to a specific product called debt mutual funds.
Okay.
So debt mutual funds have had a roller coaster. There's been agony and no ecstasy there. 23, so debt mutual funds sat on a short-term or long-term capital gains tax, which was indexed, which means that the actual incidence of the tax was lower than the nominal profit. Last year, they took away this benefit, and any appreciation got added to your marginal rate of taxation, that got added to your income. That continues today. There's something in the finance bill that I have seen, which I will need more time to decode, but it looks as if this taxation of debt mutual funds long-term as income might have a window which shuts, because there is something that as of 1st of April 2026, something might change. And the period that they've defined is 1st April 23 to 26. So it looks to me that by 26, they may have a new tax regime in place. and they might equalize the tax treatment of all these asset classes. So this is very, very preliminary. I would need to really look at the papers in detail. But there is this thing about 1st April 2026 in the finance bill. So as of today, your debt funds are still taxed long-term at your marginal rate of taxation. So this was really the capital gains part. There's also been a change in the securities transaction tax. So that is, it's a unfortunate tax on transactions as you make it. And so there has been a view with regulators that the equity markets are overheated, and especially the F&O section. So what they've done is they've increased the STT on F&O. So futures have gone from 0.01 to 0.02 and options from 0.06 to 0.1. What they're trying to do is probably just dampen down the
like
interest,
a deterrent.
Like
perhaps.
a deterrent to get some of the heat off the market. So, so tax is always used as an instrument of trying to modify behavior of taxpayers. So these are the two things, and as you see, markets did not like it.
Yeah, they did not, but it didn't last very long. And so I just wanted to, what's your take on how much of a disincentive is this kind of increase in capital gains tax and the STT going to be for so many of the new kind of, investors who are coming into the market, what we've seen since COVID?
No, so till the time that people see profits on the table, both kind of taxes are not a dampener, according to me.
Right.
Because when there is, when they see the kind of profits that some people have made, and again, just as a caveat, long-term markets will tend to the average. So you will get bursts of a bull market where you make supernormal profits, but those typically are, there's a reversion to the mean, and the mean return, the average annual return on the Sensex has been between 12 and 14, depending on where you pick your opening year. 12% to 14% a year over the long term is a fantastic return.
And this is, 20, 25-year data. So,
that's right.
There is history.
Right. There is history, but for somebody who has seen their money double and triple, 15%, 14% return is not very attractive. So there are lessons to be learned in the markets, but will this cause a dampener? I am not sure, because the exuberance is so much. And what has happened in the past few years is that because of both technology and a lot of financial education, there has been a huge interest in the markets. So I actually don't see demand going down.
Yeah, at least, the steady demand which has increased, that may not at all be.
So mutual fund SIPs, I think, has become a habit now. People have got used to investing. They've understood the product. This trading, we'll have to see where it goes. Because I also feel people come, taste the product and move on. So it's also somewhere a tasting of the product. Let's see how this goes ahead. But yes, markets crashed, they recovered. I think everyone is chewing over the budget. We're all like into the innards of the documents to see what have these guys done. Well,
one of the good things was what she announced around NPS.
Correct.
And NPS is a very long-term investment tool for, the average individual salaried person.
So new pension system. Just a quick history, introduced in 2004 to move central government employees from defined benefit, which is called the old pension scheme, to the new pension system. And then in 2009, it was opened up to the public. It remains one of the lowest cost ways to access bond and stock markets for the long term. And this ends in a corpus plus an annuity. So that's the product. It also gets tax breaks. There are problems with the product of a compulsory annuity, but we are not going into that. Essentially, what they have done this time is to say that you can open an NPS account in the name of your child, and when the child becomes a major, that NPS, that PRAN, the number of your NPS account is a PRAN number, PRAN number. It becomes that child's number then, that they can just continue that for the rest of their lives. So people who want to start investing for their children's retirement, which is I think a long shot. You first invest for their education. Yeah. But should you want to start, which is I think a great idea. You're starting really early on a low-cost product, and then there is such a long runway ahead. So even small amounts will grow very large. Yeah. The other is that there is something on employers getting deduction. It has increased from 10 to 14% on the contribution which the employee makes, which was a deduction allowed to the employer. Right. So a couple of benefits for the NPS in the budget.
Like you said, NPS is one of the deductions still allowed in the new tax regime.
Yeah, that's right.
So that's an important thing because they want to continue that, obviously.
Yes, they want to continue that.
Incentivize.
So I have a first principles problem with a deduction in the new the new tax system, is when you promised no deductions, you should have just stuck to no deductions. You already have two. Yeah. You have a standard deduction, you have an NPS. 5 years later, we are back because every year there'll be something which has to get added. So I don't want to quibble on it, but yeah.
Okay, and one more very important tax-related announcement was the announcement to abolish angel tax.
Correct. That was a big one.
Yeah. In today's environment where we are seeing a lot of startups coming up and provide employment, I think that should go down well.
Right, it has. So that's been a big bugbear for a lot of the startup community, saying that why will you tax a notional amount as income?
Right.
And it is strange that this is a notional difference between the valuation and the market price. Yeah. And those two numbers can differ.
Right.
There's somebody who's giving me this valuation. How do I arrange this money to pay you income tax? I don't have it in my hand. Right. So, and again, when they do the cleanup, there's a similar problem in bank deposits. So I'm just relating two very different things on two different points of the risk return spectrum. Your bank deposits interest is taxed on accrual, not when you get it.
Yeah.
So every year, so that's unfair. Right? So it's very similar. Like if you've done it for this, you should do it for the bank deposits as well. Tax me when I get the money. What if I break the deposit early? I've paid tax on the higher rate.
Then you have to go claim the refund.
Very difficult, right? So, and for the tax that you've paid, refund, who knows, will come or not come. So, angel tax, great for the startup community. India has got such a vibrancy around this sector. So I think it's a step absolutely in the right direction.
Yeah, and in all of this, now these are all income and tax related changes.
Yeah.
Maybe everything put together does, bring up a little bit of that consumption number that everyone's hoping.
I think the biggest boost to consumption is going to come from employment, jobs. And there has been this problem that we've seen jobless growth. So jobs are growing, but not fast enough. We are a labor-intensive country, and we need both manufacturing and service jobs.
Yeah.
There has been increased capitalization. So they have built capital into manufacturing rather than being labor-intensive. We are seeing capital-intensive manufacturing, which for a labor-intensive country
is counterproductive.
Because then you have millions of people who need either free food plus. So you will go on redistributing to people who are not going to get jobs.
Yeah.
So the biggest way to boost consumption is to create jobs. Now the government cannot create jobs. Everybody wants a sarkari naukri. Everybody wants a government job, but that's not the job of the government to create these jobs. They have to incentivize the private sector. So just in that context, I want to say two things.
Yeah.
One is that, a country will grow when you invest, right? So when we invest in, say, a home loan, our asset grows over the long term. So I can borrow to invest in a home, or I can borrow to have dinner. The two has very different consequences. Eating dinner off borrowed money is useless, but creating an asset which appreciates, taking an education loan, buying a laptop to work, all these increase my income and my asset value. So 1 rupee of capital expenditure has a multiplier of between 6 to 7. What we hear is it's between 6 to 7 rupees. In the past few years, government has really pushed the pedal on capital expenditure because the private sector was not in a position to invest. So who will invest? government or the private sector. Last few budgets, government has really increased it. And today, 30% of the budget, total budget, is capital expenditure. It is, I think, 3.4% of GDP today at 11.1111 trillion rupees. Okay, that's 11 and then 12 zeros behind that. Okay, that much money is going into all that we see. Roads, ports, airports, all of that. It's visible. You cannot deny that this capital expenditure has happened. So the good thing is that they have continued with the interim budget number of 11.11, and they are not pulling back from this investment because there is still a gap between the private sector coming in and the government stopping capital expenditure. See, because the government has other priorities. This 11 trillion could go into education, it could go into health, it could go into the socially needed parts of the economy which need a hand. But you don't have that space because if the government does not invest in capital, then growth goes down and this whole story unravels. So see it from the point of view of the government that I will do it longer, I will continue with the spend till the private sector is able to take the baton over. And to that extent, there have been some proposals which...
there have been some proposals, but before we get to that, despite what, as you were saying, they have pushed the pedal on the capex, they have also managed to maintain that fiscal deficit number, and they've actually, done very well on that front. And just, if you can simply explain what that translates.
Talks about
because fiscal deficit will be there in headlines and fiscal consolidation will be there. But what should, what should it mean to you and me?
And honestly, it's just jargon. It is just the excess of the expenditure over the income. So if you spend more than you earn, that thing is called deficit. And like what I said is that this deficit, if it is too large, will derail our lives. The collection agents will start calling, we are unable to pay debt because interest payments become very large. So the government, again, around, this is 2003 or 4, they promised that we will start reducing the deficit down to 3% on the fiscal deficit, revenue deficit 0. So basically, we want to reduce the deficit to 3. We are on that path of, we are at 4.5, 4.9 with a promise to 4.5 next year. So in an election year, which it was earlier, there was a temptation to breach this, which they did not. I mean, to their credit, it is very tempting to breach this deficit number and say, no, let's give handouts, let's do farm loan waivers, let's do this. They held on to that line, and that's the continuation. So these are very good signals to the rest of the world, to the rating agencies, to capital allocators, to pension funds, to everybody out there, that this is a prudent household. They look after their debts, they don't splurge too much, they buy houses, they don't spend on dinner. So this is how you interpret this fiscal deficit number. This is why it's good. We want to take a loan, but we want to take a loan to build assets. We don't want to take a loan to pay interest, to pay subsidies, to do farm loan waivers. That's how you should decode it.
And eventually it does have an impact on the final interest rate that you and I pay on loans, etc., or everybody else pays on loans. So it really does translate. If fiscal deficit remains low, then our interest rates remain low, and that really is a benefit for everybody.
Inflation, because the government can always print money. That possibility, we can't do that, they can do that. But there's a cost to that printing money, which is inflation.
And that drives up interest rates.
And that is a tax on everybody.
Okay, so coming to what you were talking about earlier, which is incentivizing the private sector. Right? So now, obviously, as we were discussing earlier, the government can't, strong arm the private sector into kind of,
They've tried it.
but, just short. But these are some of these things are actually good. Some of these steps that she's announced, she's announced a lot of skill programs, internships, but also a lot of incentive through I think there was something about first-time employees getting a direct transfer benefit, and also the company hiring them getting a benefit. So do you want to like touch upon some of that?
Right. Again, see it in the context of what are they trying to do? They're trying to induce the private sector to hire more people.
Right.
It's as simple as that. Because how do you boost consumption? By jobs. Where do the jobs come from? From the private sector. How do you incentivize the private sector to say, we will give you benefits if you employ more people?
Right.
And the kind of benefits are that, so one is to labor itself.
Right.
So the first time employee gets 1 month wage up to a maximum of 15,000 rupees for people who earn no more than 1 lakh a month. Now, 1 lakh a month is not a small amount. Okay, not like a Delhi, Mumbai, but in the smaller cities, 1 lakh a month, 12 lakh a year is a reasonable amount of money.
Yes.
Right? So for that first-time employee, they're getting some money in their pocket right away to say that the government is trying to induce people to go to work. They don't sit at home. You are getting free food. There are a lot of state benefits which come to you. But you know what? If you get a good corporate job, there are other benefits like medical insurance, life insurance, gratuity, all of that is there.
And 1 lakh means that they're addressing not just low income, but also middle income kind of.
But also it's a reflection of where the country is in terms of you're no longer a very poor country. You are a middle income country. So you are addressing. So, you know, when you decode these numbers, you realize how we have changed from thinking of like 1 lakh a month was not a figure you would have heard in a budget 5 years ago. You know, so that's the progress that you see. The other one is the EPF or contribution. So for the first time employee and employer, there's a benefit specifically for the manufacturing sector. Because again, you need manufacturing factory jobs. And then there is a reimbursement of 3,000 a month for 2 years for all the sectors. So these are specific things. Just see it in the context of boosting employment. And there is one which I think is going to be a little controversial, where they're saying the top 500 companies of India. Okay.
Yes.
They need to provide internships. And the government is going to give 5,000 rupees a month, plus a 6,000 rupees on entry. The companies need to take care of the training costs and 10% of the internship cost, which comes out of their CSR budgets. I don't know implementation.
I think we have to wait for details on that one, because how do you firstly identify top 500 there?
Market cap. I would imagine that's simple. I mean, if I'm the government, I'll say you have...
Not revenue or... it has to be size perhaps,
The easiest would be to go market cap. Because otherwise, how do you map it? So
but it's ambitious.
It's ambitious, and then how do you check what has happened?
You need a whole force to do the... and what's the penalty if the company doesn't go through?
That's right.
All those kind of details, I think. But the intention is there.
But I always am a little afraid when the government meddles in the workings of a company, of who you can employ,
and puts conditions on it.
Pay, what happens to them after 1 year. If they are not employed after that, then there is again a problem. So yes, this whole apprenticeship thing became a big deal in the elections, but is this the way to solve it? I don't know. So maybe an incentive, optional incentive to companies to say, you do this scheme and we will give you money directly for you.
Like a direct benefit to the company.
Rather than this. That's right. So mixed bag, I think the direction is right. But I think it's really growing up in a socialist country where the government was everywhere. You look behind the sofa, the government is sitting there. They meddled in everything. They fixed interest rates. They fixed IPO prices. They were everywhere. So I think it's more like PTSD. I don't want to ever go there again.
Go back there. But you know, Monika, on that note, on a lighter note, in this direct benefit transfer, which they have said that every first-time employee, they will give them a direct benefit in 3 tranches for their 1 month salary. They have said that the second tranche can be accessed only if they go through an online course on financial literacy. So I think that's far from, the socialist kind of mindset. So maybe, small steps, but Sounds bizarre, but I think, at least there's some thought going in a different direction. But last thing to you, Monika. This is their first full budget in, they have another 5 years, the government. Could they have done more? Is there an ask for more for the common man?
So honestly, because this is a mid-year budget, interim has already happened, there hasn't been that much time to really get into it.
Right.
I think I'm happy to wait for budget 2025 to really see where they go with this. Okay. So this is work in progress. They couldn't have changed too much from the interim. I think despite that, they've made a whole lot of changes with capital gains, with tax rates, all of that. They've done probably what they could, but I would really hope that they fix this whole capital gains.
Yes. It's still not as streamlined as one would want it.
It needs to be. And also, probably, more thought through things on basically how do you boost private investment? What is it that they can do?
Yes.
And some of the things, Lisa, I think are not part of the budget because they have to do with, she did mention the Jan Vishwas Act 2.0, which is to reduce compliances.
Yes.
So Jan Vishwas 1 was to reduce the criminalization of things that companies do. Simple, silly things like not having lime washed your canteen walls could get you a jail term. These are part of that British era rules. So a lot of that has got cleaned out. So I think a simpler compliance, less red tape, all of those would go far more into job creation, which is really the goal.
She's also talking about comprehensive kind of overlook into the IT Act over the next
to rewrite that Income Tax Act.
So
from that thick book, I'm hoping it becomes like this. If you've seen it every
sure
year,
about
it gets like...
we like thick books. But thank you very much, Monika. I think, there is a lot for the common man to look forward to, and at least directionally, intentionally, it does seem that the government is committed to doing the right things for economic growth, and that does involve eventually getting everybody along in that journey rather than, just few segments of our society.
That's right. Absolutely. Thank you so much.
Thank you so much for joining us on this post-budget analysis. I hope that you did listen in keenly and you did get a takeaway or two on how it affects your money life as well.